According to Stats Canada, Canada's economic growth did pick up earlier this year, but it didn't quite meet the expectations that were out there. And this might just push the Bank of Canada to cut interest rate when it makes its next announcement in a couple of days on Wednesday. The GDP actually grew at an annual rate of 1.7% in the first quarter of the year. That fell short of the 2.2% that analysts had expected and way short of the Bank of Canada's own forecast of 2.8%. And then when you add to that the fourth quarter's growth, that was adjusted down to 0.1% from an earlier estimate of 1%. This GDP report is crucial. It is the last major economic data point before the Bank of Canada's interest rate announcement, like I say, on Wednesday. Now, the bank had previously hiked its interest rate, the benchmark rate, up to 5%. That's where it sits today, from a low of 0.25% way back when they started this hike in order to tackle inflation. The big question now is when do they start lowering rates without derailing that effort in order to reach the 2% inflation goal that they've set. When we look at market indicators like interest rate swaps, as of today, they're suggesting about an 80% chance of a quarter percentage point cut on Wednesday. Catherine Judge, she is a senior economist at CIBC Capital Markets. And she says the Bank of Canada remains on track to cut interest rates in June, given the cooling seen in inflation and the fading of momentum in GDP over the quarter. In the first quarter, GDP growth was driven mostly by strong consumer spending, increased business investment in things like machinery and equipment, but there was a slowdown in inventory accumulation, and that was a major drag on the numbers there. Interestingly, the household savings rate, that actually climbed to 6.9%, up from 6.2% in the previous quarter. That is the highest now since early 2022. Despite this good start in January, economic output leveled off in March, although preliminary indicators right now, preliminary numbers are indicating a 0.3% GDP growth in April. Doug Porter, he's the chief economist at the Bank of Montreal, and he kind of sums it up when he says, taking all these pieces together, the economy churned out some moderate underlying growth in the first 4 months of the year, but has come up well light of the Bank of Canada's latest estimates. The economy has had a pretty tough time generating strong growth over the past year. When you look at Canada's fast-growing population, the per capita output has actually dropped. Then you add on that the higher borrowing costs. That means that households and businesses are cutting back on their spending. So the Bank of Canada's efforts to control inflation, they are working. We've seen the annual inflation rate slowing to 2.7% with the latest numbers. That's down from 8% just a couple of years ago. The big question now is whether this progress is enough to have them start cutting rates. In his commentary, Porter also noted there are respectable arguments on both sides of the decision, but we believe the balance of evidence points to a cut. We've been calling for a June cut since late last year, and we will stand by that call. So certainly all eyes are going to be on the bank's decision in just a couple of days. So the odds are 80% that the bank will cut on Wednesday. Next question, I guess, is what would happen to the Canadian housing market if the bank does in fact follow through on that and starts their rate cuts this week? First thing that pops into a lot of people's heads is that the lower borrowing costs with the lower rates, it could tempt those who have been sitting on the fence over the last while to dive into the market. And in fact, there are a lot of potential home buyers who have in fact been holding off. They've been waiting for the rates to drop before they continue on with their house hunting. I'm a little skeptical on that, though. I don't think that we can expect a huge break initially on the mortgage payments, at least not immediately. When you think of how the bank does this, they trim rates slowly. The current home prices are still pretty high, and that will still lock a lot of potential buyers out of the market entirely. Since mid-2002, sales in Canada's real estate market have been languishing below their 10-year average. The combination of steep borrowing costs that we've seen, the uncertainty hanging around when these interest rates will start, have had buyers, trading a little bit carefully. And like I said earlier, sort of sitting on the fence on that. If rates do drop on Wednesday, let's say to 4.75 from the current 5%, it might spur things. It might shake things up a little bit. A recent survey by Royal LePage, it kind of backs these numbers up. And it says that about half of those who have put their home buying dreams on hold over the past couple of years are ready to jump back into the market once the rates fall. But there is this wild card I spoke of. A single rate cut might not do a whole bunch to reduce the mortgage rates, at least in a material way. If demand does spike, probably the worst thing that could happen then is that prices would climb even higher than they are today. That would push more and more people out of that dream of home ownership. That would become more out of reach for a lot of our fellow Canadians. Experts do seem to agree that even if it's a quarter point cut, that would offer some limited relief and it might give some buyers a little bit of breathing room, but it's certainly unlikely to do anything major to close the affordability gap. Another thing to keep in mind is that even with a rate cut, it's unlikely that mortgage rates are going to fall as much as you'd hope, because fixed income mortgages, they're more influenced by the long-term bond yields than by the Bank of Canada's policy rate. So people here, they might be thinking that, this is great, they're going to start cutting, I can lock in some awesome rates for the next 3 to 5 years. The reality is that there might not be much movement in those rates. The last thing to consider here is that even with a potential rate cut, the average home price still hovers just over that $700,000 level. So that still remains a pretty big barrier for a lot of Canadians. Even though real estate values aren't as steep as they were at their peak back in February 22, affordability continues to be a major hurdle for a lot of would-be homebuyers. Looking for a balanced investment solution that can help you grow your money and generate cash flow? Consider the BMO Balanced ETF. This is a fund that invests in a mix of global equity and fixed income ETFs from BMO. The BMO Balanced ETF, it adjusts its portfolio every quarter and it matches the strategic index asset allocation weights, and this ensures optimal diversification and risk management. By investing in the BMO Balanced ETF, you can benefit from the experience of BMO Global Asset Management, which is a trusted name in the industry. The BMO Balanced ETF, it's ideal for investors who want growth and income solution that's simple, transparent, and cost-effective. Visit bmoetfs.com today and find out more. If you do fall into that group that believes that buying your own home is just a pipe dream, you should know about a company called Addy. Addy is a Canadian company and it brings quality real estate deals to everyday people. They believe that everyone should have the opportunity to own property, regardless of how much money you make, your age, your gender, or your background. Thanks to Addy, those dreams can now become a reality. It is open to all Canadians in all provinces and territories and is Canada's largest real estate crowdfunding platform. If you want to learn more, you can join the Discord community on the website. It is a super active, great place to chat with thousands of other Addy members. To get 50% off your Addy One membership, use the promo code BEAVIS50. That's BEAVIS 50. I will put a link to their website in the description of this video. I'm sure you've noticed that whenever you're shopping online for a hotel room or an airline ticket, the price seems to change every time you click on it. First time you look at it, it's okay, it's in the ballpark, it's affordable. Next time, of course, it gets more expensive. And this is a frustrating experience that's usually due to algorithms that adjust the prices based on your own activity and the demand that you're showing. Now that dynamic pricing, as is known, seems to have spread to the gas pump. And if you look at an app called Gas Buddy, it's an app that helps you find the cheapest gas in your area, and that sounds like a great thing. But imagine if the gas stations were to use Gas Buddy and keep an eye on each other in real time, and suddenly it goes from being this helpful tool for consumers to a way that gas stations can secretly collude on prices. And this brings us to a troubling new trend. We have had dynamic pricing for quite a while now where prices are automatically adjusted to maximize the profits based on demand. I don't think inherently that's a bad thing, but things are getting worse now and companies are now starting to use these algorithms to monitor their competitors' prices and not just the activity that you're showing online. Then they adjust their own prices constantly, and this is a practice known as algorithmic collusion. And it is like digital price fixing, but without the need for human involvement. And consider that price fixing by humans is currently illegal and in fact can result in penalties of fines or even imprisonment up to 14 years or some combination of those two. In the cases here, despite there's clear harm to consumers by this type of activity, Canada really hasn't tackled the problem yet. Now, the Competition Bureau has called it a prominent theoretical challenge, which is a little bit misleading because it's already happening. It's not theoretical. In fact, it's happening right now. Now, in the U.S., they have actually taken stronger actions on this, and the Federal Trade Commission and the Department of Justice, they've made it clear that colluding via algorithms is illegal. They've introduced new legislation to prevent that. Lena Khan, who is the U.S. Federal Trade Commission chair, she pointed this out last year. She said that AI tools that firms use to set prices for everything from laundry detergent to bowling lane reservations can facilitate collusive behavior that unfairly inflates prices. So what do you feel that we can do about this? To me, Canada certainly needs to catch up and address the laws that surround this new type of price fixing head on. There has been some movement in that direction with Bill C-27, which could bring a little bit more oversight. Pretty evident to me we need stronger action than just that. I would say that the government needs to ban the practices outright. That would protect consumers from these inflated prices. It would help keep everyday prices down, everyday costs down. In short, we need some new rules that are going to keep up with these high-tech pricing schemes. Air Canada pilots, they're asking for federal help to resolve their contract talks with the airline that have now stalled out. The Airline Pilots Association, or ALPA, represents over 5,000 pilots, and it has announced that despite a year of negotiations, 6 months of voluntary mediation, they're still far away from an agreement. The union plans to step away from the voluntary process on June the 15th. They plan to file a notice of dispute with the Federal Minister of Labor and request a conciliator. Charlene Hudy, she is the head of the union's Air Canada contingent. She expressed the pilots' frustration in a video message, and she said, "Unfortunately, Air Canada continues to undervalue your contributions to the success of this airline." And she highlights the significant gap between what the pilots are asking for and what the airline is currently offering. Air Canada responded by saying that they are committed to finding a fair solution. In their statement, the airline said, "Air Canada has worked hard and in good faith to reach a new collective agreement with ALPA under the bargaining protocol, and the talks conducted under the bargaining protocol led to significant progress." The airline also reassured customers that their travel plans wouldn't be affected during these negotiations. The union here, they want to achieve gains that were similar to those that were won by pilots in the U.S. last year. Pilots from Delta, United, and American Airlines, they secured pretty significant pay hikes during their negotiations. And the union here says that the wage gap between Canadian and American pilots is unacceptable. If a conciliator is appointed, there will be a 60-day period for more talks. That would then be followed by a 21-day cooling off period. And then, if no deal is reached, the union could be in a position to strike. If you are not already subscribed to our Pulse newsletter, I'm going to make that very easy for you. You can click on the QR code on this screen here, or I'll put a link in the description. I am here on Mondays and Wednesdays with this report. As always, thank you so much for watching this video. We'll see you on Wednesday.